just a couple of observations, something just to think about. And full disclosure, again, this is all stuff that he has access to. There's no secret sauce where I have access to a policy that Rob doesn't. But I just want, as you go through this, you may or may not feel completely comfortable getting to the finish line. You've got to have all your options. Okay. So I'm going to share my screen. Let's see if we can get my computer to be friendly. Casey, tell me when that comes up on your side.
Yeah, I can see it.
Okay, gotcha. So that's going to be recorded. So I just wanted to make sure that that's coming up. Now, this was that initial email that we were discussing, right? That came by and said, or came back from Rob saying that $3 million goes in, and I'm just going to jump across, and we get a $7 million death benefit.
Right.
That's a pretty big jump. Okay.
Yep.
Now, the part that really got me, that was the question, is this right here, the accumulated value. And you're still seeing it, right, Casey?
I am, yep.
That accumulated value out the gate on a $3 million deposit to have a $2.9 million accumulated value. I'm very curious what kind of policy, what specific details. There's a bunch of various different things that you can adjust, largely the projected rate of return on a policy, perhaps a variable or an indexed policy. Are you familiar with those two terms, variable and indexed?
Somewhat.
Okay, just if I may, just a quick explanation that an indexed policy, if you look at indexed, it's also called IUL, Indexed Universal Life. Indexed Universal Life is just that. It is indexed to a reference stock market index. Money from the client is not invested in the market specifically. It is just simply using the market as a reference point, S&P 500 index or the NASDAQ index.
Right.
There are illustration adjustments that can be made on an indexed universal life that says, let's look at this policy as if we got 7% every year or 6.5% every year. That's never going to happen. But the illustration allows for this fixed, click that button, and then the illustration shows that for 20 years. Okay.
Right.
It's just not a realistic thing. Then the other one you have, right? And this is one I'm not really sure, again, which one we've got here. I'm guessing it's one of these two. Then you have a variable.
Okay.
The VUL, you saw that, Casey, where I almost forgot how to write U. The VUL is variable, and variable means risk, and that's stock market connected. That is stock market connected, where yes, you can actually lose money, but you can also project out with very nice rates of return. I'm guessing this is not that. But again, just when you hear me say indexed or variable, we're just not sure what kind of a policy this is. There may be some other kind of policy that I'm just not thinking of right now that he used to cut and paste these numbers from. Okay. So this column, I'm going to roll back up a little bit. The thing that I looked at here is you do have two things that you have to seriously consider. One, how much death benefit do you really want or need in your overall planning? And is this a case of we really don't worry about you, Mike, having access to the $3 million? We really just want the bigger death benefit to transfer into the future. Or is it, I don't really care. What's that?
That's the piece. I mean, I would only put this amount of money in if I had relatively clean access to it to live on if I needed it.
Gotcha. Right.
I want it to be protected if I don't go after it, but I want to be able to borrow against it or cash surrender, whatever, if I need it. In other words, I'm pretty risk averse in terms of giving up too much money before I die.
Understood. And this is where I want to highlight this so that, again, you can ask these questions and use it as a baseline for where you end up. And we'll start here, that there is it's important to note that I'm looking at this as if it is a universal life insurance policy because of the total charges column. Okay. In a whole life, it's a different type of policy. We won't go into the details there, but just know that a whole life policy pegs the cost of insurance. All right, I'm going to write that. Again, this is all being recorded so you can follow this, but COI.
Yeah, well, I
Cost of
know what
insurance.
wait. I know what COI is because I'm involved in a piece of litigation representing an insurance company that has raised their rates due to COI, and there's a class act. There's a million of them like.
Yeah.
Say you can't do that.
No, you got to be careful because they have to do it for an entire class. But if they don't do it with the right variables,
I know you got to use the right variables, the right uniformity. I know all that.
Yeah. So the COI or mortality charges in this example, they actually move. They're pretty high in the first year, but they're significant. I mean, they don't stay fixed. They go up, which leads me to believe this is definitely some kind of a universal life policy, and that's fine. But you just have to know that you're looking at over $100,000 a year just in simple charges against your $3 million.
That's the cost. That's the amount I pay for them for taking the risk for that year.
It is. My concern is this column here. And I'm actually circling or marking off the accumulated value.
Right.
So if the total charges are, and I'm going to mark right here, Casey, you see where it's at age 77?
Yep.
If the total charges are $101,000 3 years into the policy, how in the heck is this policy going up every single year?
Well, I assume they're figuring I can make 7% on $3 million, which is $210,000. I don't know.
Which is never going to happen. Just so you know, and I sell life insurance. So, but I'll be the guy right now to tell you to set your expectations. Never going to happen. You will have some years where you'll have good rates of return for sure.
Yeah.
But the idea that we're illustrating the $3 million number as relatively level and actually going up despite a $118,000 cost in the fifth year, unlikely. This is not to say this is overall a bad idea. I'm just making sure that you put the things together. That's all. Okay.
So what would be a reasonable rate of return to plug into that?
With these types of things, I never put in more than 5.5, usually 5.5, because I want to see what it looks like under standard conditions. And yeah, because there's going to be years plugged into the actual illustration, which will be about 40 to 50 pages long, that will show years where you get a 0 rate of return. Now, here's the key. Years where you get a 0 rate of return, but those mortality charges come out every year no matter what.
I know.
So in a year where you get a 0 and you take $100,000 hit, it is impossible for the cash value to catch up, no matter what rate of return you get next year. So again, not to shoot holes in the use of life insurance, because when you really do the math, there is very little that any great investment advisor could do to replicate a $3 million number turns into 7 tax-free.
I got it. Yeah.
On a guaranteed basis. It is truly one of my favorite things. I do love the use of life insurance for estate planning. But I remembered, that's why I've double checked. I remembered this talk about cash value. I just want you to be aware of it. Okay.
No, well, let me just, if I understand, for 3 million to go to 7 million, it's a little more than doubling. That would mean, well, it takes 10% to double in 7 years.
Right.
So if you cannot get a tax-free return of 10%.
Well, no, it's not even a 10%. Yeah, you'd have to be somewhere around a 12% rate of
Right,
return, right?
right.
After tax to get the 7. Yeah.
No, that's what no, that's what I said. It would be 10% tax free.
Oh, yeah. Yeah. No, you can't.
Uh,
No.
Even if you said, all right, it's 10 years out, that's 7%.
Right. Right. And if I'm going to circle it right now. I mean, if we come out here and we circle that kind of age 80, 81, if we're honest with ourselves, at age 78 to 80, you have now crossed that mortality threshold where it's all bonus time, right?
Yeah.
So the numbers, could you turn 3 million into 7 million in your lifetime? Absolutely. You definitely could. Could you do it on a guaranteed tax-free basis? Pretty much impossible. So from a planning point of view, life insurance is a great wealth creator and a wealth transfer device. What I want you to see, and I'm going to show you as a very simple example, nothing in stone, but I wanted you to see when I looked at this, based on your desire to have more access to the cash, right?
Yep.
I looked at the life insurance a little differently, right? Because the goal was to move a certain amount of money out of your estate, right? Being able to move $3 million and using the life insurance as a vehicle to do that, there is another way that you might consider it. So I'm going to move to that right now, and we'll kind of wrap up with that and see what kind of questions come up, okay?
Okay, all right, good.
Okay, hold on just a sec. Here we go. Where to go? I'm going to grab, is it that one? I think I like this one. Doesn't matter. This is just a different, now, Casey, my screen changed over, right?
Yep.
Okay, good. So there's two different ways to look at this, right? This is an example from another company, but this is, for me personally, this is how I would prefer to have any kind of life insurance example discussions, the full illustration. And you'll see down here, Casey, it's 33 pages long, right? So there's a lot to it, but we're not going to go through all of it. I just want you to see that this example is $3 million, but the death benefit is 4.5 million on a guaranteed basis. You see that?
Yep.
So 4.5, oh, Mike dropped off, but we're going to keep recording. He'll come back on. So the situation,
he might be where he is now. He might pop back in.
Yeah, no, I figured he sounded like he was walking inside. Yeah, there you go. Okay, so you'll see here that there is a non-guaranteed option. Do you see this non-guaranteed 3.5?
I actually lost you when you started. I lost you when you started this.
No problem. We actually didn't get too deep into it.
I could see the thing now. I'm pulled over to the side. So
okay. So what I'm looking at here is just a policy example, full illustration though. This is an actual full illustration, no cut and paste on this one. This is just an example of, let's take a look at very basic, notice the rate of return, 3.5. Just really conservative number, right? Now we take $3 million. This is a single premium, 3 million goes in.
Right.
Now I'm going to use my, come on, eraser. My eraser is not being, there it is. Notice the cash value in this policy example under a 3.5%, which is far more realistic. This does have an indexed market and all of that, but I want to know what it looks like with really low numbers. Notice what happens to the cash value. Nice and stable, right? Just goes up nice and stable. Do you remember what the surrender value is next to that?
I assume that's the amount that I could give the policy back for and take cash.
Yeah, that's the penalty. You take a really big sting. That's how the insurance company covers their costs, is they have a surrender charge that says, don't leave us or we're going to keep a bunch of the money. Okay.
All right.
But you'll notice that the cash value is in fact actually very stable at 3.5, which means that if we get it better than 3.5, obviously the cash value and everything will look that much better.
Okay.
Now, the sacrifice here is,
If I
that
use the
benefit.
cash value, I'd have to pay interest, right?
What's that?
If I use the cash value, I'd have to pay interest if I took the money, some of the money out.
No, we would encourage you to take the money out in a loan, which is tax-free.
Well, I don't want to, but the loan, I'd have to pay interest to the insurance company.
You do, but the way that life insurance policies work, the loan is not necessarily, you don't have to pay it back. You're not required to pay it back. You really should. It all depends. But the key here is if you're earning a rate of return and then you take a loan and you have an interest rate on a rate of return, they're generally keeping up with each other.
All right.
Now, that's not to say that you should ever take a loan on these policies just haphazardly. You really got to carefully consider it. Had a client not long ago that I met them after they had taken a loan 5 years prior, and no one reminded them that they used it for a business purpose. They should pay it back. $600,000 loan later, it's a little harder to pay back. It saved their business, but now they have this loan that they never paid back because they didn't have to and they forgot about it. So
Wow.
yeah, it saved their business in a big way. But
Yeah, but I mean, that's not so bad. It's their money in the first place.
that's
They
true.
took
And their cash
took the-
value had continued to grow along the way. While their loan had grown, their cash value did grow. In this case, though, you could access cash value in the form of a loan. You could also just take cash value out. And yes, you might have to pay some income tax on earnings. But the piece I want you to see here is that, yes, we've got this consistent, right, now much more, in my opinion, a much more realistic cash value growth, but you're sacrificing the big death benefit. I personally believe this is far more realistic to look at, by the way, that we're looking at, something that if we can get better than 4.5, 5, 6 million, that'd be great. If you can get 7, awesome. I just seems like that is just a shot way off in the distance. We can kind of hope for it. Does that make sense?
Yeah, and you know what? I don't really. That's of secondary importance to me because
Right.
with something like this, I get 2 benefits. One, it's out of my creditor estate, for lack of a better term.
Right.
And 2, if I need to use it, I can.
Right.
And 3, if I don't use it and the creditors don't get it, then I get a $4.5 million policy benefit when I die, and the kids can use it for whatever, to pay taxes.
Right. And it's also another way to make sure that Casey's always nice to you.
Casey's always going to be, yeah, that's true, because I could cut her out and put you as the beneficiary.
That's what I tell my daughter, right? I can always change the beneficiary on my life insurance, right? Now, now you mentioned something, again, you've been specific on this several times, which is access.
Yep.
So there is a key here that is missing, and I'm just going to write it for now. This is a deeper dive that we don't have time for today. But Casey, remember this: if you haven't already heard the term MEC, modified endowment contract. When you dump $3 million into a life insurance policy, every single dime of gain will be taxable immediately, all of it. It's not taxable unless you take it out, but you asked that question, Mike. If you take money out of this particular type of policy, or even the previous one that Rob showed, because you put all of the money in a lump sum, it violates the modified endowment contract rules in the IRS code. And so be it. That can work if that's what we really want to do. It can work. But I like to look at a different option, especially as young as you are. What?
This is the one where you put the money in some sort of escrow account or something.
Yeah. So I looked at this and I said, well, instead, what if we use, it's called a whoops, let me grab my blue pen. I like my blue pen. A PDA, premium deposit account. A premium deposit account that says, if we, instead of putting in, let's see, instead of putting in, what was the deposit amount? It wasn't 3 million required. It was,
yeah, it was 3.
Here, it was here. See, instead of putting in 3 million, you put in 2.67 million. And then
Okay.
the policy is paid from the premium deposit account, which earns interest. And the premium deposit account funds into the policy over the course of 10 years. And any gains in the future and all of that, it preserves the tax benefits of the policy.
All right, well, I have two questions for you.
Sure.
First, what is the 2.6 million in the PDA? Is that creditor protected?
It
The
is,
same
because remember, the policy is held by the islet. It's outside of your estate.
But is the PDA held by the islet?
Yeah, it's all connected to the policy, which is all part of, all under the islet.
But then secondly, it may be true that
Oh.
when it comes out, it's not taxable, but the 2.6 is going to be making money during the period of time it's going to be taxable, right?
It's inside the policy. So hold on just a quick sec. I got to go grab
All right.
something here. Hold on, sorry. Quick interruption.
All right, good. Case, if you need to go,
I'm good for right now. I've got like 15 minutes.
this is all very interesting stuff. Might make you some money when I die.
You know what we need you to do? We need to
Nope.
get you. We need to get you registered with the Eisenhower Hospital.
Yeah, did you? Yeah, Lorna told me about this 24/7 program. And then, did you see that Tony sent me an email?
I'm looking at that right now. It plays in part with what I showed you. I mean, San Francisco has zero information. Napa has better information, at least showing where they are in vaccinating people. And looks like Riverside County, at least they know that they're trying to get stuff to people. They're worried about old people who don't know how to use the internet.
Yeah, okay, so
You can register and be getting emails. That would be good.
where is Tony? Tony's.
All right.
I mean, his is,
You know who
Gotcha.
Tony is, Casey?
no, I don't know who Tony is. Sorry.
He's the head dog. He's the head guy at the Bighorn, and I asked him. He's helping me get this stuff.
Okay. All right.
So back on track, love the Amazon deliveries. Mike, your question about the premium deposit account, the part that I cannot remember is I believe because it is connected to the policy, you do not receive a 1099 related to the premium deposit account. I will have to verify that. It may be irrelevant. It all depends on what ultimately, what ultimate type of policy you come up with.
Yeah, I bet that it's taxed at the PDA, and it's not going to be tax-free to you until it's taxable when it comes back out. But I might be wrong.
Right. See, I've had a PDA account and I never got a 1099 for it, so I'll have to double check
All right.
that. So
Okay.
the whole idea here, though, is you can dump money in, and if you look at the premiums going in over time, I mean, comes back to this idea, if you just wanted to cancel it, there's a big chunk of money that hasn't gone into the policy yet and wasn't subject to surrender charges.
Who controls the PDA? Is it a trustee? The island
No,
trustee?
it's part of the life insurance company. It's just built into the life insurance company's structure that basically you have your policy, and then associated with and connected to it, you have your premium deposit.
The money actually goes to the insurance company.
Absolutely, yes.
Right.
So it just sits in their money market, if you will, but it is directly
Maybe it
connected
is
to your
tax-free.
policy.
All right, okay.
Yeah, that's why it's not sitting in a bank account. It's actually
Okay.
at the insurance company connected to your policy.
Okay.
So the idea here is that you can do a single premium, you can do a 7-pay premium, you can do a 5-pay premium.
Right.
There's different ways to do it, but the overall thing to remember was that instead of putting in 3 million, you actually put in 2.6 million.
Right.
That's a pretty substantial difference. And depending on what the overall goal is, it may be appropriate, right? So I just wanted you to be aware of it. Again, we're not
So
there
the
yet.
main benefit of that is one, it's not taxable when I take it out of the policy, I guess. And then two, it's easier to collapse because there's no cash surrender value charge.
Well, it doesn't eat up your surrender value, of course, on the money that's still in a premium deposit account. right? You only
Right.
have surrender penalties on the amount that has gone in,
All right, okay.
right?
Right.
Now, there is a long-term piece I'll give you just to think about, and this will be up to Brad and your conversation with him, whatever you ultimately do with it, but you might ask him that, let's just take an example while we're on this page. Casey, you're still seeing my screen, right?
Mhm.
Okay. So, and you too, Mike, you're seeing it?
I am, yeah.
All right. Let's say that, Grandpa is 85 years old now, right?
Fuck that. Pardon me.
And then we go over here and you look at the cash value right there, 2.5 million, right? And one of your kids comes to you and says, we have a business idea. We want to start a chinchilla farm. We've got this cool idea and it's a great business model. You have the option with this type of policy to be able to take tax-free loans. The part that I forgot on the previous conversation is that if you take any kind of loans or anything on that policy, because it is a modified endowment contract, everything's taxable. Okay, you'll pay tax on all of the interest earned, right?
But if I take $1 million out of loan, I don't pay tax on $1 million. I pay tax on the pro rata between the growth and the principal, right?
Yes, but all of the growth is lumped into the first position. It is last in, first out.
First out, okay.
Yeah, last in, first out. So it can be problematic where, now you got this great tax favored benefit of life insurance that's lost.
I'm kind of convinced, but why would anybody not use a PDA? What is the downside?
Well, the PDA, if there's no need for, having any contact with that money ever again, then I'm often looking at what is the least amount of cash value that we can get in a policy, most amount of death benefit for as little premium. Cash value becomes completely irrelevant.
Right.
That's the reason. So when you look at it, it's all in the design and what you're trying to accomplish with it. Okay. But the part here is that, you got a long life ahead of you. There is a great opportunity to use these types of policies as a family bank. I mean, the ILET could invest in things, to be honest. You don't really want to put real estate in an ILET, but if the ILET wanted to make a loan and it's just paper outside to a family business, those are things that can be done using a non-MEC policy. So just something to think about, okay?
Yeah.
I think that's where I wanted to stop today. I just wanted you to have some information to think on. I mean, you're already down the road. I'd be curious to know which companies we're looking at, just so I can have a general idea of what the heck kind of policy is being illustrated.
I totally agree. I haven't been pressing Rob because it's not as timing crucial for me. It's more, let's get this thing done right. And then secondly, because of his personal situation, but I will